I think the only way to keep the system alive and to have any hope of bringing back manufacturing and growing our way out of this problem, because remember, Triffin's dilemma says if you are the world reserve currency, you will always run trade imbalance. Why the vice president is saying being the world reserve currency isn't maybe so beneficial at this stage of the game. So the only way you grow your way out of it is to back the Treasury. And if you start with 50-year duration, you're not going to have everyone sucking all the gold away immediately. So you have a lot of runway to let the price really rise so that when it comes time to redeeming those treasuries, it's not as painful as it would be today. To me, it's the only pathway to keep United States hegemony and supremacy. For our growing indebtedness, you need to find an avenue to attract a demand for the Treasury market without letting rates go parabolic.
As global debt spirals to unprecedented levels, experts like Andy Schectman are raising critical concerns about the long-term sustainability of sovereign finance. With U.S. federal debt officially exceeding $37.12 trillion and unfunded liabilities, such as Social Security and Medicare, pushing the total obligation near $200 trillion, conventional solutions, such as tax hikes or spending cuts, are becoming politically and economically unviable. Compounding the issue is a notable decline in global demand for U.S. Treasuries, creating the risk of a rate shock if yields must be raised sharply to attract capital. According to Schectman, this scenario could trigger cascading failures across interest rate-sensitive sectors like banking, insurance, real estate, and equity markets. In his view, the current path is unsustainable and demands bold, unconventional solutions. One proposal Schectman highlights is the introduction of ultra-long-dated Treasury bonds, such as 50-year issuances, pegged to the price of gold. Unlike the traditional gold standard, this approach wouldn't tie the dollar directly to gold, but would instead use revalued gold reserves to back the Treasury market itself. This could help restore confidence without inflating yields to dangerous levels. Analysts like James Rickards estimate that a revaluation of U.S. gold holdings could generate over $6 trillion in accounting capital, providing the government with a runway to stabilize debt issuance, lower borrowing costs, and even incentivize the reshoring of manufacturing. Schectman argues this approach could be the only viable path to avoiding either a debt default or a catastrophic surge in interest rates that would implode the broader economy. Supporting this hypothesis are extraordinary trends in global gold movement. Schectman points to record-breaking U.S. imports of physical gold, including large quantities sourced from the UK, Singapore, and Australia, volumes far exceeding normal arbitrage or tariff-related explanations. Vault congestion, unusually high premiums, and logistical delays have all signaled that this gold is being accumulated at the state level, possibly in preparation for such a monetary shift. Schectman suggests that this accumulation is less about trade dynamics and more about laying the groundwork for a gold-supported treasury system. If this strategy unfolds, it may represent not only a financial pivot, but a fundamental rethinking of the U.S. monetary architecture, one that trades fiat-driven expansion for commodity-based stability in an increasingly fractured global financial system. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I've been sitting on my hand. I will say that I have devil's advocate in terms of perhaps the way the federal government looks at it, and I want to bring into focus Judy Shelton's argument of issuing 50-year treasuries. Mm-hmm. Because as we said earlier, we have that $37 trillion debt, but the unfunded liabilities, Jason's point, in Medicare, Medicaid, Social Security exceed $175 trillion. By the government's own admission, we're pretty darn well near $200 trillion in debt. There's no way to pay that off. You bring in Doge, well, at least right now there's not, unless we were to bring all the manufacturing home and grow our way out of it, which would lead to the Great Depression long before we were able to grow. But just for a moment, if I would, and that would be that if we take a look at this massive indebtedness, obviously, and you bring in Doge who points to $2 trillion in reckless spending that we could save, but yet Congress doesn't have the political will to do anything more than $80 billion, and that $80 billion that they agree upon is 38 hours of spending by the government, amounts to nothing. So to Judy's point, in a world where the Treasury bond is losing demand globally, and it is not, that's not something that's even debatable. How do you find demand in a country where Trump wants to raise the debt ceiling? There's going to be another $3 trillion deficit. We owe $28 trillion in treasuries that are coming due in 3 years. Yet we only take in $5 trillion in tax revenue. He wants to lower taxes, but not lower spending. That's a problem. And even if you don't lower taxes and you keep it at $5 trillion, that's $15 trillion. We owe 28, but that doesn't take into account the $3 trillion this year and whatever we do the next 2 years in deficit spending. The math doesn't add up. So how do you find demand for the Treasury bond in that environment without letting rates go parabolic to attract that demand? If rates do go that high to attract demand, what happens to stocks? What happens to bonds? What happens to real estate? What happens to the banks? At 5%, they started to break. What happens at 10? What happens to the insurance companies who are loaded with treasuries? It's called bang, the Great Reset, everything implodes. So enter Judy Shelton. You reshore all the gold. Oh, wait, didn't we just say we become net importers of gold? I think we did. Over 100 billion that we know of. You contemplate revaluing gold. Where is gold held? Oh, yeah, in the gold revaluation account. That's the name of it. You can't make it up. It's happened 3 times before in this country. Who would that benefit? Well, that would benefit every central bank on the planet, number one. It would also benefit the United States government if indeed it is the entity behind this massive month over month imports of gold at record levels, the largest import ever into the history of the COMEX on the May contract. Who's standing for delivery for almost $9 billion in gold? You put all this stuff together. Okay, Judy, so we peg a 50-year treasury to gold. Why? Well, because what that does, if you do revalue it, now James Rickards says 24,000. He comes up with that number by taking the money supply and dividing it into the gold that hasn't been audited since 53. And he gets this 24,000, which would give the Treasury general account $6 trillion free and clear. Treasury would issue gold certificates to the Fed, who would print the money out of thin air and give it to the Treasury. Those gold certificates give the Fed claim on the dollar value of the gold, not the gold that belongs to the people. So that printing of the money completely devalues the dollar, just like Nixon did in 72 and 3, and just like Roosevelt did in 33. Devalues the dollar, which is what they want to do, creates copious inflation, which is the lesser of two evils rather than default or hyperinflation, but it would create a lot. That makes it easier to pay off the debt, but that still doesn't deal with how do we get low borrowing costs. Well, we peg the Treasury to gold and redeemable upon maturity. Therefore, you can offer zero coupon treasuries because that inflation hedge is the gold. It's not the 8 or 9 or 10% yield that would kill the markets. Boom, everything blows up. Instead, you peg gold to it. You got a 50-year runway. And then in that environment, because of the low borrowing costs, you inflate your money to pay down the debt. The Treasury gets $6 trillion under Jim's scenario to start paying down the debt. And then you start reshoring your manufacturing at a very, very low cost of borrowing. And you try and produce your way out of it. In my opinion, what the hell do I know? I think it's the only way that you can get out of this quandary we are in without either massive hyperinflation, which leads to interest rates going to the moon, which blows it all up, or quantitative tightening, which has interest rates go to the moon, which blows it all up. I think Judy's onto something. I think that would be the first step, would be to reshore all the gold. We see that. So I think what Jason is talking about has greater legs than people would give it credibility for. I don't care what the banks have to say about this. We are so far down the road that we've really run out of options. Inflate, you're dead. Raise rates, you're dead. It's time to think outside the box and unconventionally, and I think that's what Judy's whole theory is all about, and I wouldn't put past really a reasonable chance of something like that happening. So I just want to throw that out there and play devil's advocate because I see a clear path to this getting crazier than people would ever think in terms of where gold will really go and what the plans are by the administration to use gold, not to back the currency, but to back the Treasury market to keep rates low and incentivize demand for the Treasury market. I do. I don't think they can back it to the currency like they did in prior to 33, where gold backed M1, which was not M2, which is the broader measure. M1 is the currency in circulation. But President de Gaulle from France proved something, and that is that convertible currencies convert. That's like Gresham's law, where the bad money chases out the good money. And I don't think they want to make it convertible on a currency basis. I think they'll sacrifice the currency. And unfortunately, a lot of people will suffer with higher inflation. But I think the only way to keep the system alive and to have any hope of bringing back manufacturing and growing our way out of this problem, because remember, Triffin's dilemma says if you are the world reserve currency, you will always run trade imbalances.
Right.
That's why Vice President
trade deficits, but yeah.
Yeah, why the vice president is saying being the world reserve currency isn't maybe so beneficial at this stage of the game. So the only way you grow your way out of it is to back the Treasury. And if you start with 50-year duration, you're not going to have everyone sucking all the gold away immediately. So you have a lot of runway to let the price really rise so that when it comes time to redeeming those Treasuries, it's not as painful as it would be today. To me, it's the only pathway to keep United States hegemony and supremacy. For our growing indebtedness, you need to find an avenue to attract a demand for the Treasury market without letting rates go parabolic. To me, it's a genius idea that Judy has, and I can't see a clearer path other than something like that.
Amid rising economic uncertainty and concerns over inflation, more Americans are moving their savings out of traditional bank accounts and into gold. A recent Gallup poll indicates that nearly half of Americans have either already bought gold or are actively considering it, marking a significant shift in public sentiment. This comes at a time when the US dollar has lost approximately 10% of its value, while gold has gained over 38% in the same period, illustrating a stark contrast in purchasing power. According to precious metals expert Andy Schectman, these figures reflect not only a market trend, but also a deeper loss of confidence in fiat currency and banking institutions. The movement is further strengthened by the Basel III regulatory framework, which classifies gold as a Tier 1 asset, allowing banks to utilize fully allocated gold holdings to meet their capital requirements. However, many argue that this should be in customers' names, not as bank-owned assets. This broader movement toward gold is not just a reaction to market volatility, but a deepening structural shift in how individuals and institutions view financial stability. As Andy Schectman points out, central banks, arguably the most informed and well-capitalized entities in the global economy, have been aggressively accumulating gold in recent months. Since November alone, over $100 billion worth of gold has reportedly been delivered into the COMEX market, suggesting that this trend extends far beyond retail investors. Meanwhile, traditional banks are witnessing a steady exodus of deposits as individuals shift their capital toward assets perceived as more secure, such as precious metals and U.S. Treasuries. However, with interest rates suppressed and inflationary pressures rising, even Treasuries are offering diminished returns, further driving attention toward gold.
And I think you can just look at this year as a prime example. The dollar's down 10% and gold's up 38%. So you're talking almost a 50% swing. And if the state were to have been holding its reserves in gold, it would be far, far, far better off from a standpoint of purchasing power than it would be just holding it in dollars. All fiat currencies are inherently meant to die. And the policies of this current administration center around a weakening dollar and lowered interest rates, which is inflationary. This is why the smartest money in the world has been accumulating gold hand over fist, that being the central banks. And I would add into it somewhere in the neighborhood of 100 billion with the B dollars that we know of, and I would argue there's probably a lot more that isn't reported, has been delivered into the COMEX market since November. And you're talking the most well-informed, the most well-funded, and the most sophisticated traders on the planet. Now, who is doing this? Who's got those pockets? And so, yeah, I think that there is no question at the highest level. And the only ones who would vote against that would be the banks, because it takes away, obviously, much of their power and leverage, as they've already seen a mass exodus of deposits leave the banking system chasing yield into treasuries. I'm sure the last thing they want is to see legal tender in gold, which would be a far, far, far more sound way of holding your your wealth. And, people get too focused on return or yield. There is no yield on gold, obviously, and they focus too much on that. But if you look at its performance over the last 25 years, it's doubled the performance of the 10-year Treasury. So it doesn't need yield attached to it, because inherently what it does is it maintains your purchasing power. It sniffs out the stealth monetization or the stealth inflation that is inherent to the system and continues to move higher. Whether you look at last year, gold was up 40%, the 10-year Treasury up 4.5%, or this year, the 10-year Treasury up 2.5% halfway through the year, but the dollar down 10, you're negative 7% in the hole plus. Yet gold's up 38%. So when you talk about allowing the constituents the ability to get out of the way of irresponsible fiscal policy and arguably brain-dead monetary policy, it would be the best thing in the world for the constituents. Jason, am I wrong in saying that it was a unanimous bipartisan vote in Utah, but for whatever reason, the governor vetoed for the first time a unanimous bipartisan agreement? Am I wrong in saying that?
So it was unanimous, I think, in the House, and I think nearly unanimous in the Senate. And it's certainly certainly of his own party, the Republicans, was unanimous. And I don't think that's ever happened before.
Is reasoning in that case when you have the entire will of the people and the majority of the legislature saying, yeah, let's do this. The state feels it's smart enough to add $100 million into its coffers. Yeah, I mean, what you are doing, Jason, not only in building a wonderful business, but also in really representing sound money, and in many respects, the United States, the will of the people with the legislature is fantastic, and it's a growing trend that I think will continue to manifest. You're seeing it here in Florida. I spent time with some of the people in the economic war room yesterday on the phone going over all of this. And I think really this is a grassroots movement that is gaining momentum, certainly around the country. So it's exciting to see, and let's hope it gains some more traction. And rumors that I hear, and I won't substantiate them, but rumors that I hear is that there is actually a good chance, and someone that I would love to talk to, and certainly, Adam, you may want to try and get him on your show as well, as Representative Alex Mooney from West Virginia, who has passed these or tried to float these bills federally to remove capital gains taxes and to call gold, especially that gold that would be issued by the U.S. Treasury, the Eagles, money, and rightfully so. And for these bankers who claim it's unconstitutional, actually, they're wrong. The Constitution says it is treasonous to use any money that is not species, which is gold or silver. So it's, as usual, the bankers are self-serving and wrong. And guys like Alex Mooney, guys like you, Jason, and others who would much rather hold their money in something sound and stable. And let's not forget the overreaching risk that we see in an undercapitalized, over-leveraged banking system. Obviously doesn't want to see more of their deposits leave, but why would you leave your money in a banking system and in a currency that's being inflated, a banking system that's leveraged and undercapitalized and teetering and has bail-in legislation? I mean, it all seems that we're getting to that point. So yeah, I let's all hope. And this may sound corny, but hey, I suppose if you are in any of these states where they're considering it, and Jason, is there a spot to go to so people can see what states are considering this legislation? Because a simple contacting your legislature probably is a good idea if we are in any of these states where it is currently under, I guess you could say, review, or if it's in some sort of a what would it be, a panel or a council determining whether it's right for the state or not.
Gold's recent surge is the result of several converging factors over the past 18 months. Persistent inflation, the U.S. national debt surpassing $37 trillion, and escalating geopolitical tensions in regions such as Eastern Europe, Taiwan, and the Middle East. These challenges have prompted global central banks to amass gold reserves at an unprecedented rate, boosting their appeal to both retail and institutional investors. As economic uncertainty and geopolitical risks intensify, gold has evolved from a mere hedge into a core component of many investors' retirement strategies. According to the Expert Vault's latest research, gold reaching $5,000 per ounce by the end of 2025 is increasingly plausible, driven by a weakening US dollar under the strain of debt and interest rate pressures, ongoing geopolitical instability, and the global shift away from reliance on the dollar toward diversifying reserves with tangible assets like gold. Do you see gold continuing its upward trend as a reliable safe haven asset, or do you expect market factors to create volatility? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.